Demand for warehouses in Canada is so hot that the national vacancy rate has fallen to a record low of 1.6%. Cities like Montreal and Toronto are commanding some of the fastest rising prices in the world. But as central banks continue to hike interest rates, will this boom be sustainable? Jeff Olin is the CEO of Vision Capital, and he joins us now. Thanks so much for making time, Jeff.
Thanks for having me.
So I'm curious about this demand for warehouse space and where you think it might be coming from, because this is CBRE data about the vacancy rate being at that low of 1.6%. But, over the course of the pandemic, we heard about online shopping really increasing, and then the need for that space increasing as well. But that's being, dialed back a bit in terms of the e-commerce surge. So where do you think this demand is coming from?
There are really at least three powerful, and I call them more secular, demand drivers driving this. The first you've touched on, e-commerce. E-commerce spiked to about 25% of total retail sales during the pandemic. And as you cited, they've come off a bit, maybe 16, 18%. But by 2025, they're likely to be 30%. And this is powerful. For every $1 billion in e-commerce sales, this requires about 1.25 million square feet of new industrial space. Now we're anticipating a recession, and even though there's a recession, Walmart sales might come off, but Walmart still needs that distribution space to service the sales they have, and with e-commerce a growing amount. Secondly, reshoring. This is powerful. It's long-term. These are 50-year decisions. The reverse of 60-year trends coming to fore. And you've seen this. You saw a big announcement yesterday, Brookfield financing a facility of Intel. Mm-hmm. You've seen two multi-billion-dollar chip plants announced for Austin, Texas. You've seen Intel investing $100 billion over 10 years outside Columbus, Ohio. Canada couldn't rely on the United States when Donald Trump blocked our masks from 3M in April 2020. Do any of us want to rely on China for pharmaceuticals? I don't think so. So this is powerful. It's a second one. And the third one is the replacement of what has been known as just-in-time supply chain, getting your goods just when you need them. That didn't work so well in the pandemic. It doesn't work so well in a volatile geopolitical climate where there's wars. To just-in-case supply chain, making sure you have additional inventories to service your customers. And because of the pandemic, inventory levels as a percentage of sales are about 10% lower than long-term historical levels. We think you're going to see that grow to 10 to 15% above. Just to get even to pre-pandemic levels, you need about 400 million square feet of absorption. In the United States, for example, 800 million square feet, and last year there was 400 million square feet of absorption of industrial space. So there's powerful demand drivers, and the balance of supply. You got to watch supply, and supply is tough. Land prices are up, development charges are up. It's difficult to build. You've got inflation, supply chain issues, and that's why your preamble about vacancy rates being low are low. Rents have skyrocketed.
So much of what you said there was very interesting, Jeff. I wonder on the just in case instead of the just in time shift. Does that increase costs though for those companies making those choices? Could that then become a little bit more difficult to do in the future if there is an economic slowdown?
Certainly increasing inventories will require working capital, but from a real estate perspective, one has to realize that when you look at the costs in the supply chain in logistics, labor, working capital, and transportation make up like 80% of the costs. Rent is only 6%. And that's why you've seen rents go up so much, is that the amount of rent is really a minor point to making sure you have access to labor at effective cost, to making sure your transportation nodes where you can deliver those goods. And so these are the key factors but certainly, as inventory goes up and it's cost working capital, but you'd rather have more inventory than not have sales.
So for Canadian investors, Jeff, that are interested in this space, there are a couple of REITs that they could check out. Summit Industrial, that is that exclusively owns Canadian warehouses. Can you dig into that one a little bit for me?
Sure. So this is about a $3.5 billion market cap. Toronto listed, about just over 3% yield. We think it's trading at a 20% discount to the underlying value of its real estate. And you're talking about an entity where the gap between their in-place rents and current market rents is north of 50%. It's extremely well managed. The balance sheet is very solid, about 27% gross to book value. Great management team, takeover target, this highly aligned management team, and 70% of its real estate are in those markets that you cited, Toronto and Montreal, where vacancies and the fundamentals are amongst the best in the planet.
And what about First Industrial Realty Trust?
Again, our blood is supply and demand, and is the premise of this segment. And First Industrial is a New York Stock Exchange listed $7 billion market cap. It's trading at about a 20% discount to what we believe the net asset value of its real estate is, about $66.50. Again, supply and demand. Over a third of their properties are in New Jersey, Southern California, and Central Pennsylvania. Again, world's lowest vacancy rates and highest demand because of their distribution network that is so close to major urban centers. They have a 6 million square foot current development pipeline, another 14 million square feet behind it. All told, that's going to increase their portfolio, which is not small, by 30%. Again, takeover target, control is in the market. You know, Blackstone has bought 5 REITs since December 2021. Industrials on the radar screen. These are both takeover targets, and that's how you may realize this discount to the property value.
And Jeff,
cheapest way to buy real estate is through the stock market.
Just quickly, Jeff, do you or your firm own either of those two that we were just talking about?
We do own both of them.
Okay.